Hey Bowtie Nation, Joseph Hogue here, and you know we love us some of that index fund investing for that stress-free part of our portfolio. Index funds like the Vanguard 500 ETF, the VOO, let you be the market without having to worry about picking stocks. The problem is that the dividends on index funds tend to be, excuse my language, craptastic. That Vanguard VOO pays you a dividend of less than 1.5%. That means invest $1,200 and you can buy yourself a Big Mac meal at McDonald's. That is one Big Mac meal per year, so enjoy that, I guess. But there are alternatives. Index funds that not only give you that easy, stress-free market returns, but also a dividend that's going to put cash in your pocket. I'm going to show you 5 of the highest yielding index funds with yields as much as 4 times the stock market average. And starting you off with a 4.7% dividend is the Vanguard International High Yield ETF, the VYMI. And okay, we're not talking about double-digit dividends here. With a broad index funds, you're not going to get that 11% yield you might with a specialized fund like the popular QYLD, but you're also not going to get the volatility and the sleepless nights. Over the past 2 years, the QYLD has lost 18% of its value, jumping up and down on any market stress, while the VYMI has produced a solid dividend, a 9.8% price return, and much less stress. Now, I will show you how to combine some of those high-yield ETFs like the QYLD in a strategy later on, but for this video, we're building an index fund part of your portfolio. We're looking for that perfect balance between safety and cash flow. And I like that Vanguard International Fund because it's a part of the market most U.S. investors don't invest in. The fund holds over 1,300 high-dividend stocks of companies based outside the U.S., so you're getting that broad exposure to that international theme. It's also a value investor's dream, with the stocks priced at an average 9.5 times their earnings. That is less than half the 21 times PE ratio for stocks in the S&P 500. And these are all going to be those big, familiar names like Toyota, Shell, and BHP. The average size of companies in the fund is $44 billion, so we're still talking about that safety in mega cap stocks. Now, I'd still add a US-focused index fund as well, something that gives you that growth in US companies, but this is a great addition for cheap stocks and a high dividend. Helping you manage your portfolio is today's sponsor, Passive, a portfolio tracking and monitoring platform that can show you all your investments in one step. Passive connects with your brokerage accounts. Here you can see I've connected accounts from Robinhood and E-Trade, including multiple accounts in each. You'll get detailed reporting on everything from dividends to how much you have in different assets and stocks. And that's important because with so many accounts set up at different brokers, it can be easy to lose track of your entire portfolio. With Passive, you can see where your biggest exposures and risks are with the click of a button. Even better, you can see how much you want in stocks or assets as a percentage of your portfolio. Here I've taken one of my retirement accounts and set limits for how much I want in each stock. Passive will tell you when your portfolio has breached those limits and the trades that'll put it back in place. You'll also get email alerts when your portfolio has drifted. It is a great tool for keeping you on an investing plan. Nation, it is so easy just to chase stocks, and before you know it, you've got 40 or 50% of your portfolio in a single stock. Passive is going to help you keep on track, so look for the link I'll leave in the description below. The free plan will get you started with automated tracking, dividend notifications, and to help you keep track of multiple portfolios. Or try out the Elite plan with a 100% money-back guarantee. Back to our index fund list, and one I've highlighted before, the Global X US Preferred ETF, ticker PFFD, with its 6.5% dividend. Preferred shares are a special type of stock with rights that go beyond the normal shares. Preferred shares have a set dividend yield with a payment that must be paid out before stockholders get any of their dividends. These investments also usually have a higher dividend yield as well. For example, Bank of America issues preferred shares paying between 6 and 7% dividends, while its common stock pays a dividend yield under 3%. Preferred shares are also higher up on the list of liquidation, so if a company does file bankruptcy, preferred shareholders get paid before common stockholders, but after creditors. Best of all, though, preferred shares also enjoy some of those growth benefits of regular stock. Most preferred stock is convertible into regular stock if the share price reaches a certain point. Basically, the company is saying, here, enjoy this higher dividend yield now if the stock price goes nowhere, and potentially a higher return if the shares take off. With that Global X Preferred ETF, you get a fund holding more than 220 of these preferred share investments for that broad exposure across the entire theme. These are all going to be large, familiar companies. Here in the top 10, we see big banks like Wells Fargo, Bank of America, and JP Morgan, as well as NextEra Energy and Apollo Global. Now, an index fund that focuses on preferred shares is naturally going to tilt towards those financial companies because that's just the type of companies that issue these types of investments. So you might also want to consider pairing this this fund with another one that overweights with tech or other growth sectors. We're getting more international exposure here with the Vanguard Emerging Markets Index Fund, ticker VWO, with its 3.5% yield. And even at the lowest dividend yield on the list, this one still pays more than twice the market average. I'm going to show you later one that pays more than 4 times the market dividend, but now I want to show you how to pick an index fund, how to create your own list here. First, of course, you want to make sure it's truly an index fund and not just an ETF. The index funds I'll highlight in this list are broader, based on a wider group of stocks that give you the whole market return. There are a lot of ETFs out there that may seem diversified, enough stocks to smooth out your risk, but are so focused on a theme that they're going to leave you with even more risk. For example, the iShares Global Clean Energy ETF, the ICLN, spreads your investment out over 100 companies, but because they're all focused in that same clean energy theme, the fund has plunged 32% in the last year. On the other hand, in a true index fund, you're looking for a fund that invests in companies broadly based on market size of the company, a geographic location, or asset class. That way it brings in different types of companies and themes to really truly reduce your risk. And you know I'm a cheap ass to my bones, so I'm also looking for an index fund with a low expense ratio. Every exchange traded fund, index fund or otherwise, is going to charge you a management fee. Now, this amount is calculated on a daily basis and comes out of the fund's assets, so you really don't see it come out of your account, but it does decrease the fund's assets and the share price held by the fund, so it does matter. That means I could have added something like the ProShares Hedge Replication ETF, ticker HDG, to the list. It holds shares of over 2,000 companies for that broad diversification and pays a dividend of almost 3.5%, more than twice the market average. But you lose a third of that to the expense ratio, a 0.95% fee. Now, a 0.95% management fee isn't a deal breaker in itself. I've seen fees over 1 and 2%, but it is definitely something you want to compare when you can consider you can get the Vanguard VWO fund for just 0.08% a year. Less than a percent difference in fees might not seem important, but it's almost $20 for every $2,000 invested, so I'm going to take my savings and get me that Big Mac deal. We're back to our index fund list with the Wisdom Tree US High Dividend Fund, ticker DHS, with its 4.3% yield. The fund holds shares of 384 large US companies, paying a higher than average dividend yield. And you see in the top 10 here some of our favorite stocks here on the channel. We see AbbVie with its 3.8% yield and Chevron, which pays a 4.2% dividend. These are all very large cap, mega cap companies, so this could be a replacement for something like an S&P 500 index fund in your portfolio. But as is usual with these high dividend stock funds, we see that the DHS is more heavily invested in stocks of financials, energy, and utility companies, the companies paying out those higher dividend yields, so you might not get that same price growth you get with an S&P 500 index fund, which has nearly a third of the index in tech stocks. But you get that cash flow kicker to make up for it. And I know all you out there in the nation are asking why I didn't go with the Schwab US Dividend ETF, the SCHD, that I've highlighted so often on the channel. I still like and own the SCHD, but it only holds 104 stocks compared to the DHS holding 384 companies. So for that more diversified index idea, I wanted to go with more stocks. Also, even though the DHS does charge a higher expense ratio than the SCHD, the dividend yield is more than enough to make up for it. The Schwab fund pays 3.5% yield, but if we're talking about putting more cash in your pocket, I'm going with the DHS on this one. And you can see you're getting roughly the same exposure with these two funds. Over the last 2 years, the DHS and the Schwab ETF have tracked pretty closely, both investing in those large cap US dividend stocks. I'll reveal that last index fund next, one with a 5.7% dividend, but for some of you, this could be your entire portfolio. In just these 5 funds, you've got US stocks, international stocks, emerging markets, preferred shares for some of that price upside, and higher dividends with that bond ETF that I'll show you next. Just 5 funds, and you've got exposure to all the major asset classes and thousands of investments. You are the market, and you're going to be collecting an average 4.9% dividend yield. It's more than 3 times the average on the S&P 500 index. Then for a little more price upside, you can add 10 or 15 individual stocks you really like for that core satellite strategy that we talk about, and you've got an entire portfolio for growth and dividends. From there, you just set your targets for how much you want in each index fund and stock on the passive platform and take the guesswork out of investing. You'll get email alerts when any of your investments is outside your target range. Now, for one of the highest yields of the group, the JP Morgan Income ETF, ticker JPIE, pays a 5.7% dividend yield. I I know fixed income isn't the kind of investment we love to talk about, but this fund holds over 1,500 bonds and a flexible strategy to produce those higher yields, and led by portfolio managers with more than 80 years experience. You can see here most of the bonds held are that ultra high rated for safety, more than half in BBB rated or higher, so the default rate is negligible here. Best yet, this is a monthly dividend payer, so you're going to get that cash flow every single month paid out to you on the first week to start your month outright. Make tracking and rebalancing your portfolio easy with the passive app and the link below, or click on the video to the right to see one of my favorite index funds right now, one that fixes the biggest problem in the market. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.